All right, welcome once again, Samuel here, your tutor. Today is yet another day when we are studying financial accounting, and I just felt I should start by giving a small brief, which I've tried to give. Like I indicated, we are continuing from wherever we stopped, and last class we are studying about manufacturing accounts, okay? We are studying about manufacturing accounts. So today I want just to look at one part of the manufacturing accounts that I think we didn't look at because of time. Okay. Okay. So this is a part that I didn't give much attention in the previous class. I think we looked at it, but we looked at it a bit briefly. We didn't go so much in detail. I think it came through the Q&A. So I want to give more clarification on this, and then we shall be able to jump onto our today's topic, okay? Yeah. So basically, just to still give you an understanding here, I say that the reason why we do all this, or whatever we do within the manufacturing accounts, is to help us understand how much do we incur in producing the goods that we are going to sell, okay? That is what we do when we are looking at manufacturing accounts. And the key components of the manufacturing accounts is the manufacturing account statement, okay? The manufacturing account statement, like this one. The manufacturing account statement starts from here, okay? It starts from there up to the point of getting the cost of goods completed, or the cost of goods fully manufactured, okay? That is what we do with the manufacturing account statement. And then after the manufacturing account statement, we now start on to the trading profit and loss, okay? In this question, as you can see, it's a single prepared document. This was a manufacturing, trading, and profit loss account. So it was combining everything. But if you remember, when we looked at the different formats of the manufacturing account, if you remember what we really had, I think this was our trading and profit, which basically starts from sales and then goes to less cost of goods sold, okay? And remember, this cost of goods sold, we say that this is the normal cost of sales, okay? Which looks at the opening stock. Now we add the cost of goods. I said in the previous, of course, in the normal retail business, after getting opening stock, definitely would basically add purchases, okay? But for manufacturing companies, since they don't purchase, for them, they actually manufacture what they sell, okay? So instead of having add purchases on your opening stock, you rather have add cost of goods completed, okay? So that is what basically happens. So in the same way, that is the reason why we draw up our manufacturing account statement, which I will just show you, this one. This manufacturing account or cost statement, this is how it looks. And we say that the key things that this looks at are our prime costs, okay? It looks at our prime cost, and by prime cost, I mean the variable costs, okay? The variable costs, or what somebody may call the direct costs, okay? And other direct costs, definitely we have the raw materials, we have the labor, and then we have direct expenses, okay? Any other kind of expense that is directly attributable to the product, but is not under labor or is not under raw materials. And after we've looked at the prime costs, which are direct costs, the other things that we go ahead to add are our overheads, okay? The factory overheads. And I say that these are typically costs for the factory, okay? they are typically cost for the factory. Anything that cascades out of the factory is considered within the trading account, the trading profit and loss account, okay? And then one of the other key components that comes around when it comes to manufacturing accounts is the opening work in progress and then the closing work in progress, okay? And we say that what we do when we are trying to calculate our costs of goods completed or fully manufactured, we basically add our work in progress, which we've started with, our opening work in progress, and then we less any closing work in progress. Remember, the reason why we less the closing work in progress is because these goods are not part of our goods fully manufactured for that period, okay? They will now be goods fully manufactured for the next period, okay? When we shall complete their actual production. So that is just very important. So with us all doing this, with us trying to get, let's say, the direct costs, add the factory overheads, and then get the change in working capital, work in progress, ours is to determine the cost of goods fully manufactured. Now, what we want to look at today is, once we've determined our cost of goods fully manufactured, we have two scenarios. We can either carry this figure the way it is and take it to our P&L, okay, our trading profit and loss, or we can actually add a markup, okay? We can actually add a markup. Now, in what circumstances do we add a markup? We add a markup onto our cost of goods completed or fully manufactured when we know, okay, the markup is basically to help us get a picture of if at all we had bought these goods from another person, okay, maybe our competitors, instead of manufacturing them, how much would they have costed us, okay? You get the picture. If instead of, let's say, manufacturing, for example, I'll give you an example. If I told maybe we're a bottling company, let's say maybe we're a Renzoli bottling company. If we're actually outsourcing the production of the Renzoli bottled water, how much would the other person charge us, okay? So for example, maybe internally, our cost of manufacturing the bottle of water costs us 700 shillings. If our cost of manufacturing that bottle of water costs us 700 shillings, and to get this from another person who is the competitor, okay, it would cost us 900, okay? Now, if it costs us 900, it means that the difference between the 700 that we are able to incur while manufacturing internally and the 900 that we actually incur in getting this from the competitor, the difference is our markup, okay? Is our markup. And sometimes we call it factory profit, okay? We call it factory profit. The reason why we call it factory profit, because it's the profit that we are getting on our goods for producing them internally, okay? The profit that we are getting on our goods for producing goods internally, okay? So that is very important for you to really pick. Now, having that in mind, that we sometimes have to calculate the factory profit. Now, the question arises that in most cases, remember this that you're calling factory profit is more of I don't know how to call it. Is in real terms. It's kind of it's not yet attained profit until you sell. Okay, it's just an internal perception of saying that if we had bought this thing, would be charged this value 900, and since we produce it at 7, so we have a factory profit. Now, the reason why we're calling it sort of imagined or not attained is because you've not yet sold the goods. You know that you only make a profit when the goods are out to the customer, when they pay for them, okay? So even if you've made goods at 700 and the competitor sells them at 900, the difference of 200, which is you're calling your factory profit, is not realized until when you sell these goods, okay? So of course, we know very well, those that have followed this session from the start, we have what we call the prudence concept, okay? the prudence concept, which says that we should not, of course, we should make sure that we don't overestimate our profits, okay? We should not overestimate our profits, but cater for any possible losses as much as possible, okay? So that is what we're basically trying to reflect on this today, to understand how do we now cater for the unrealized profit, okay, at the end of the financial period. Because remember, you've already transferred your goods at a profit, at a markup. Now the question is, since you're closing up your books of accounts and you have some, what we call the closing stock in your books of accounts, how do you cater for that closing, okay, the profit on that closing stock, which is not yet realized, okay? And that's what we are calling the unrealized profit. Remember, profit is only realized when you've sold. So the profits that is on the closing stock, okay, the factory profit or the markup that is on the closing stock is unrealized at the end of the financial, because you've not sold that inventory. You've not sold that inventory. So we have a scenario here. We have a scenario here where they are saying, now, for example, this was roof clad, okay? Now, once we calculated roof clad's value of finished goods, they were standing at 177, okay? They were standing at 177. But to get similar goods, if we are not producing them internally, to get them from a competitor, the competitor would charge us 194,700 for similar goods, okay? Now, if that is the case, it means we're actually making a profit by producing internally. And that is why we are saying that the difference between the market value of the 197 and then the 177 is the 17,700, which we should regard as our markup, okay? Which would regard as our markup. So this markup is what we are going to see. How do we account for that markup, okay? Now, of course, this is just saying why transfer at current market value or cost plus rather than cost price. Why shouldn't you transfer at 177 but then transfer at 194,700? And of course, the whole process is simple. We've already classified you something to do with the factory profit, okay? Basically, it's like a motivation to the people that are actually producing, okay? So like here, they're trying to indicate, for example, roof cladd's example, since their markup is 77, it means that the company is actually gaining more from producing than actually buying from the competitors, okay? Yeah, so the dilemma now comes here, like I've indicated, that the factory profit is only realized when we actually sell, okay? Is only realized when we actually sell. So us transferring this stock inventory at 194,700 to our P&L means that we are even overstating our profits, if at all some of these goods have not yet been sold, okay? So what they are telling us is that, of course, we should disclose this profit in the trading and profit and loss account as part of the overall profit. And then transferring manufactured goods at an inflated price contravenes with the realization and historical cost conversion, okay? So given that background, then how do we now cater for the unrealized profit on the unsold inventory, okay? Like we've seen, at the end of the period, we have what we call the closing stock. So we have to make sure that we cater for the unrealized profit on the closing stock. So this is what they are saying. How do we account for this is that we should open up a provision account, okay? We should open up a provision account which is used to eliminate what? The unrealized profit on the unsold items, okay? Now, some of you have come across the word provision. And provision, we've looked at in the previous classes, we've looked at provision for depreciation, which is also your accumulated depreciation. We've looked at provision for accounts receivable, which is provision for bad debts as well, okay? Now, right here, we also have what we call the provision for unrealized profits. basically the profit that we've not yet realized on our unsold items. Okay, so they're saying a provision account is used to eliminate the unrealized profit on the unsold items. If the provision for unrealized profit on closing stock exceeds the provision on opening stock, then the profit and loss account should be debited. Okay, and that means we should subtract this from the profits. Basically, we should recognize it an expense, because like you've seen, the provision for unrealized profits on your closing stock is higher than that you had on opening stock. Then they are saying we should deduct this from our profits. On the other hand, if the provision on the closing stock decreases below the provision on the opening stock, then there the profit and loss account should be credited. And this is a simple thing. Remember, your business is a going concern. So if you're ending with some stock today at the end of the financial year, and let's say there's unrealized profit on it, at the end of the next financial year, again, you also end with some other inventory. Now, the inventory you've ended with in this financial is the beginning inventory of the next financial year. And what we are saying is that get the unrealized profit on the opening inventory, okay? Compare it with the unrealized profit on the closing inventory. And we are saying, if at all the difference is, we are seeing that the unrealized profit on closing inventory is higher than that on the opening inventory, okay? If at all the unrealized profit on closing inventory is higher than that on opening inventory, then we should actually debit our account. It's basically we have more unrealized profit at the end of the year than that what we started with, okay? So we should debit our account. This is very similar even when it comes to provision for bad debts, those that followed through. We also say that, of course, if your provision, the provision you started with and the provision you're ending with, if you compare the two and the provision you're ending with is higher, it means there is an increase in, let's say, provision for, let's say, for bad debts. It means that you have to debit your P&L. So it's the same principle. So, and we are saying that alternatively, if at all your provision on closing inventory has decreased, okay, has decreased compared to the provision that you started with, then you should credit. It means the company is actually is benefiting. It means it's an increment in profit, okay? And that's why we credit our profit. So we have an example here that would basically help us to pick this information very well. So we have an example here. Mukwano Limited, the manufacturing company, had the following finished goods, okay? We had the following finished goods. So what we are saying is we have finished goods at cost 2.5. This is at the start of the financial year. And then we have finished goods at the end of the financial year, which is 4 million, okay? So they are telling us that during the period, the cost of goods completed, amounted to how much? Amounted to 30 million, okay? They amounted to 30 million. So this is what came from our account statement, manufacturing's account statement, okay? And then you're telling us that the company transfers goods at what? At a markup of 10% to cater for the factory profits. So they're asking us to prepare the provision for unrealized profit account, okay? So ours is very, very simple. Like they have indicated to us, we are going to determine the unrealized profit on our opening inventory, and then we shall also determine our unrealized profit on the closing inventory. And basically, what we are going to do, we are going to use this 10% markup, okay? We are going to use this 10% markup. So let me just try to get one of my cells here so we can basically do. So let me get here. So we have our opening stock of finished goods, okay? And this was 2.5. So it's 2.5. This is at cost, okay? This is at cost. So we have to add the markup or to determine the unrealized profit, which is the 10% factory profit. So 10% of this will basically this times 0.1, okay, which gets you 250. So it means that our new balance, okay, the opening stock of finished goods at cost plus markup is basically the summation of this, okay? It's basically the summation of that, okay? So that is what we basically do have. So we'll do the same thing for the closing inventory, but now this will be the closing. So I'll call this closing, and then I also call this closing. Sorry. Okay, I'll call that closing. So when we come here, I think we saw this was 2.5 and then this was 4 million. So I'll pick my 4 million and drag it right here and do the same thing, okay? Sorry. So I'll get 10% of this, 0.1, sorry, I did do times 1 times 0.1, which gets me 400. And then we add this together to become 4.4, okay? So that is what we basically do have. So once we have that, what we are saying is they want us to draw up our profit just to see. They want us to draw up a provision for unrealized profits, okay, account. So let's come here and say, this is Mukwano Limited. So I'm going to draw up my account here. Okay, so that is my account. Just to extend this so it is okay. So that is my account. This is my debit. Side is my credit. Okay. Now, our provisions have basically have a normal credit balance. Provisions have a normal credit balance. So what we are going to basically do after since we've already calculated our unrealized profit, which is on opening stock, which is 250 and then 400 on closing stock. What we are going to basically do when it comes to our provision, we are going to have our opening and closing, and then we're able to get the difference that we shall take to the P&L. So like I've said, provisions have a normal credit balance. They have a normal credit balance. So it means that the unrealized profit on opening stock will actually be a balance brought down on the credit side, okay? So this is this was opening stock, balance brought down Balance brought down is 250,000. Okay, and then our balance carried down. Balance carried down is actually 400,000. Okay, which is on closing stock, like the one we've seen there. So what we are saying is we should basically comparing the two things. Okay, but here we are doing it in within the account. So what we are going to do, of course, we can get the two. We can compare the two sides and see which side is higher than the other. As you can see, this side is higher. So this side will dictate the total. So the overall total will be 400,000. Okay. This will be 400,000. So even this side will also be 400,000. But to do that, we have to get a balancing figure here. And our balancing figure is what we actually taking to our profit and loss. Okay. Is what we are taking to our profit and loss account, which is 150. Okay, which is 150. So basically, in the essence, from the question, they told us that if you compare your closing inventory, this value, the unrealized profit on closing inventory, with that you're opening with, and then you get the difference that you get between the two. Okay, especially when this one is higher than the opening, then the 150 here should actually be debited to our P&L. Okay, so as you can see in this account, in the provision for unrealized profit account, it is a credit. When we go to the P&L in the trading, it will be debited. Okay, it will be debited. So that is basically the principle. It will be debited. So they are asking us right here, part of the question also. Sorry, I displayed a different paper. Okay, right here. So they're asking us to calculate to get the manufacturing statement extract. Okay, they want us to get the manufacturing statement extract. So we are going to see how the manufacturing statement would look like. Okay, these are just extracts, so it's not, we're not drawing up the whole account. Okay, so this is still Mukwano Limited. Limited manufacturing statement extract. Remember, it's the manufacturing statement where we get the cost of goods fully manufactured. So they just want us to see how the cost of goods fully manufactured will play when it comes to a manufacturing account statement. So what we are basically going to do is we are going to look at what is the value of our goods, okay, our cost, and then add the markup, and then be able to get the transfer value of the goods fully manufactured. So let's just see. So they have told us that the cost of goods fully manufactured or completed stands at 30 million. So this is what we shall have. So we shall have this here. I'll just pick this value. So our cost of goods completed is worth 30 million. And then we shall add a markup. Remember, our markup is 10%, just like the way we had up here, okay? That markup, which is our factory profit. So this will be this value multiplied by 0.1. Sorry, I think because it has UJX. Let me just remove the UJX. Can put the UJX up here. So it gets me to 3 million. Okay. So since we are now transferring at a markup, okay, our transfer or transfer costs of goods fully manufactured will basically be the summation of these two, okay? This plus that to give me 33 million. So basically, this is what the examiner needed. The reason why every time they ask you to draw an extract means that you don't need to put all the other above information. Now, in this case, the information they gave us is very limited. So they only gave us the cost of goods completed. But just in case, this was a bigger question where they gave us the direct raw materials, the direct labor, the direct expenses. They also gave us the factory overheads and so on, then we'd go ahead to do that. But in this case, they computed everything and they gave us this value, and all they want us to do is to be able to add the markup and then determine to get our 33, okay? So that is very important. So similar to this question, they also asked us for a trading and profit loss account extract, okay? So even in the same way here, they also want basically an extract. So I'll just copy this. So they want us to draw up. So Mukwano Limited profit and loss extract, okay? So what we are going to basically do, remember what happens with our profit and loss account trading? We start with sales, okay? We start with sales, but we don't have sales. We don't have sales. And here what we're just doing is an extract, okay? So I'll just start with the cost of goods sold, because after sales, then you subtract the cost of goods sold. So that is what I'm basically going to start with. And remember that in its own has the opening stock, okay? Has the opening stock, and then it has the cost of goods, the cost of goods fully manufactured, but at this time we are transferring it at a higher value, and then we shall be able to less our closing stock, and then proceed ahead to, of course, determine our gross profit, which we cannot determine, and then add the factory profit, okay? The factory profit, and then less any decrease or decrease in provision, okay? So basically that is what we are going to basically do right here. Just a moment. So I'll have, so basically for the sales, we don't have anything, okay? So this is just, can put just like X. So under cost of this, we said we are having opening stock of goods fully manufactured, goods fully manufactured or finished goods, okay? And opening stock now, when we are transferring goods at a markup, so we should even have the opening stock of finished goods at, we should take the 2.75, not the 2.5, okay? So I'll still take the 2.5 down there. I'll take the 2.7, that, okay? And then what we are going to also do, we are going to less, okay? So before lessing, we are going to add. What we are adding is this, the transfer We are adding the transfer of cost of goods fully manufactured, okay? This is what we are adding right here. And remember, here we got 33 million, okay? Sorry. We have 33 million, okay? And then after that, we then go ahead to less closing stock of goods fully manufactured, which we also computed right here to be 4 million, okay? To be 4 million. So we should be able to get our cost of sales, okay? With that, our cost of sales or cost of goods sold will now be this, okay? Add this and less the 4.4, okay? So that is what we basically do have. That is what we basically do have. As you've seen, we've been able to get the 275, add the 33 million, and less the 4 to get the 31,350,000. Okay. Now, in this case, if we had the sales figure, we should be able to determine the gross profit. Okay. Just in case we had the sales figure, we would have been able to determine the gross profit. So our gross profit definitely would have been this figure less the cost of goods sold, okay? To determine our, so even this, which we can denote it by just a star, okay? Now, after we've determined our gross profit, it can also be a loss, by the way, okay? It's not that it should be always be a profit. After we've determined this, what we are saying is that we add, okay? We should go ahead to add what we call the factory profit. We should add the factory profit. So do you remember the profit we just made? The profit, this markup that was on our cost of goods fully completed. This is our factory profit for the period. So this 3 million is supposed to be added onto our gross profit. It is supposed to be added right here, like that. Okay. So that is what we should be able to add. Now, after that, of course, after you've added your gross profit, one of the other things that you should also do now is to add or less your unrealized profit on inventory. Now, in our case, we actually have, when you saw, this is what we had for opening inventory, and this is what we had for closing inventory. So ideally, the profit on closing inventory was higher than that is of opening inventory. So the unrealized profit that we actually got right here, the 150, is supposed to be less, okay? It's supposed to be less based on the guidance that we basically had. If you followed this through from the start, we had somewhere where we went ahead to say that if at all, right here, just to remind you, if the provision for unrealized profit on closing stock exceeds the provision on opening stock, then the profit and loss account will be debited and it will be subtracted from the profit. So this is what has happened. In case it was the other scenario that happened where our provision of closing stock was lower than the provision on opening stock, then we would actually add it there, okay? So for us, our case, this is what we do have. So what I'll basically do when it comes to this, I'll basically get this 150 and less it, okay? I'm going to less it. So I'm going to less my unrealized profit on closing inventory. The closing inventory of finished goods. The reason why when it comes to manufacturing account, we keep adding finished goods is because we also have inventory in raw materials, okay? So it's good for you to distinguish the two things, even when you're in the exam, okay? So once we have done that, of course, we are lessing this, then we should be able to now determine our, of course, overall net profit in case we also had other expenses that we should basically deduct, okay? But for example, just to understand that this is just an extract. So since it's an extract, we shall basically end where we have ended, okay? So we shall basically end there because it's an extract. An extract is just to, the reason why they ask for an extract, the examiner wants to know if you know how to input such items, okay? The examiner wants to know if you know how to put such items into respective accounts. So that is what basically I wanted to highlight before we start on something new, okay? Yeah, so in case you have any question, please you use the chat box to ask, but I believe you've been following. So we have different illustrations. Actually, I think this illustration had it. Usually, the examiner will include something in the additional information, just like I think you saw, this is an illustration. This is an illustration too, okay? That tried to bring in that concept. It tried to bring in the concept of transferring goods at markup. So you can see, for example, this question, they were still saying that manufactured goods are transferred from the factory to the sales department at a manufacturing cost plus of 20% for factory profit. Finished goods stock are inflated by the same percentage, just like what we've just done. So you definitely be able to transfer that. So I will not do this because already you have these notes and we've covered most of these things. So please try out, and if you fail, there's a solution right there that can be able to guide you. And in case you don't understand the solution, I'm always available to give you more guidance, okay? And then we have an exercise within here. So I would love to see that you try out that exercise and share on the WhatsApp group with the rest of people to be able to understand what we basically do have, okay? Yeah. So within your notes is also this topic. I think you remember we had 3 topics in this handout. We had a topic on accounting for nanny for profit, then manufacturing account, and then lastly we had this other topic of what? Of control accounts and reconciliations, okay? Control accounts and reconciliations. Now, control accounts and reconciliation is one of the topics that is on our syllabus. And once we learn control accounts and reconciliations, we will be in better position to actually be able to even attempt questions that are from the perspective of single entry, okay? Now, questions on single entry, in most cases, these are transactions that have been made by small businesses that don't have accountants, they don't have systems in place, okay? So for us to be able to determine key balances for such accounts, we deploy what we call the control accounts, okay? We deploy the control accounts. So basically, from learning perspective, we want to understand the nature and function of control accounts. We also want to be able to illustrate typical entries in a control account. And then we should also be able to prepare control accounts, providing the accuracy and of the accounts receivable and then the accounts payables ledger, okay? Yeah, so we are going to see. We are going to basically understand this even as we get down. So basically, for you to understand from the definition perspective, what is a control account? They're telling us that a control account is a summary account appearing in the general ledger. It is a summary account appearing in the general ledger for purposes of controlling all detailed ledgers in the ledger to which it relates, okay? Defined as a summary account appearing in the general ledger for purpose of controlling all the detailed accounts in the ledger to which it relates. Now, we can have a control account, for example, the accounts receivable control account. The accounts receivable control account basically gives a summary, okay, of what is appearing in the normal accounts receivable account, okay? So it helps us to control whatever is within the accounts receivable account. We basically use it to reconcile the accounts receivable normal account, okay? So as you can see, we have, it's basically an alternative account, okay? So we have what we call the debtors control account. These are the control accounts that we do have. We have the debtors control account, and then we have the the creditors control account. Now, debtors control account, just from debtors can also be accounts receivables. Other people can call them receivables without the word account, but it's basically the same thing. So we have the debtors control account, and then we also have the accounts receivable control account, which is the same thing. And then the other is the creditors control account, which alternatively is called the accounts payable control account. So this is the principle. They're telling us that the balance of control accounts should be the same as the sum of all individual ledger balances to which it relates, okay? So remember, the control account basically is one that is keeping, is basically, it's an account in which a record is kept of the total number of similar but individual items of the major account, okay? So we have an example here, right here, where they are saying X had the following debtors at the end of the year, 31st March 2004. So we have Peter that has 200,000, and then we have Joy who has 300,000, okay? So we are saying that therefore at the end of the year, the debtors control account would have a balance of how much? Of 500,000, which is the summation of the two things. Which is the summation of the two things, okay? So basically as that. So you should be able to understand. So now we should also know what basically do we do when it comes to control account reconciliation, okay? We should understand what comes with a control account reconciliation. Now, of course, when we are doing the control account reconciliation, remember, we have to make use of the actual account, okay? For example, if it's the debtors control account, we should be able to utilize the debtors ledger account itself, okay? We should be able to utilize the debtors account itself. So, and of course, like we've said, the total of the individual ledger accounts should be able to total to what we have in the control account, okay? So that is pretty very key. So just to also understand that the entries in the accounts receivable ledger are predominantly the sales journal, which sales journal records the credit sales. This sales journal can also be called the sales order, okay, sales order book or sales day book, okay? That is a sales journal. Then the cash book, of course, cash book records cash received from customers. And then cash book discount column records discount allowed. The reason why we are listing all this is that this is all that relates to receivables, okay? This is all that is relates to receivables. And it is from those three documents that we pick information that we should put under our receivables account, okay? Of course, we also have return inwards, but predominantly these are the respective documents, okay? These are respective documents. So Also to note that, of course, there also be some minor items. For example, like bad debts written off, okay? And then we should also have things like balance brought forward from the previous period. So we are also going to make sure that, just to understand right here, that opening balance we are talking about, of course, these are usually from previous balances, and that could be from your balance sheet and so on, okay? We already talked of these. So just to get down here, so we have something similar. We have a format here for our accounts receivable, debtors, control account, and I want you to pay a good attention on this thing, because this is the gist of the control account, the debtors control account. Okay. Now, you know very well we've said that the debtors control account is not in any much difference from the normal ledger account, the normal debtors ledger account. But what this does, it's basically an alternative account that is controlling the other, okay? Making sure that we can basically use it to make reconciliations of the main ledger, okay? It's like an alternative to the other, okay? So in the sales ledger or debtors control account, just like the way we have debtors to have a normal debit balance, you know, debtors are assets, and assets have a normal debit balance. So in the same way here, in your sales ledger or debtors control account, you should have a balance brought down on the debit side, okay? Your balance brought down on the debit side is because of that, because of the nature of the account. So the balance brought down is on the debit side, while the balance that is carried forward or carried down is on the credit side, okay? We know very well that as it is on the credit side here, as a balance carried forward, it is actually a balance brought down in the next period, okay? So that shouldn't confuse. So balance brought forward should be on this side, and balance carried forward should be on this other side. Now, once we now understand the balances, ours is now to ask ourselves, what increases our debtors? What are some of the things that increase our debtors? And the things that increase your debtors are things that are actually put on the debit side. Anything that increases your debtors is what is put on the debit side. And anything that reduces your debtors is what is put on the credit side. Principle from the principle of understanding what an asset is and what is how does an asset react to let's say when it's reducing and increasing. So since in this case, when our debtors are increasing, now credit sales increase our debtors. You'll agree with me that when you sell on credit, it means more debtors are coming in, so they will increase your balance. Okay, that is one case. Then we have the debtors check dishonored. Now, the reason why we are seeing the debtors check dishonored on the debit side is because if at all we have gotten a check from a debtor has paid us, and once they pay us, definitely we adjust our books of accounts, okay? We go ahead to credit our debtors account. Now, if we go to the bank and the bank bounces that check, it means that the debtor whom we had written off, whom we had thought that they had paid us, is now has to pay us another amount of money, okay? Either maybe through cash or give us another check. That is why we go back and do what? And reinstate the data, okay? We reinstate the data. So the reason why we debit right here is because we are reinstating this data, because this data to whom this check relates to is no longer written off as earlier on. It is actually a data that is continuing, is a continuous data who has to pay us in the next month or in the near future, okay? So that is why the debtors check dishonored is actually on the debit side. The other is, of course, the debtors refund for overpayments, okay? Now, in the same way, remember it is the debtors pay us, okay? The debtors pay us. Once the debtors pay us, what we basically do we credit the debtors account. We credit the debtors account because our debtor balance is reducing with them. So what we are saying is that just in case the debtor had paid us more than what they should pay us, that means we credited more money than what we should have credited their account. When we're in our control account, any debtor's refund for overpayment should be debited because what? It tries to reduce on the amount that we had previously credited, okay? It's basically a counter transaction that is taking into effect of what we actually did when we were actually receiving the payment from them, okay? So as we credited the payment from them, here we actually debiting with the overpayment so that we're able to net down back to the actual value that what would have actually paid, okay? Yeah, so that's very important. So that is why we have the credit sales, the debtors check this honored, and then the debtors refund for overpayment. Now, very similar to when it comes to the credit side. Now, the credit side, I said whatever is on the credit side are items that reduce your debtors, okay? Are items that reduce your debtors balance. Now, we have one here that is being written, the return inwards. Now, return inwards, these are goods that we have sold to our customers, and our customers return them for various reasons. It could be either our goods are spoiled, or maybe we gave them more than they actually ordered for, etc. So the return inwards reduce our debtors balance. Why? Because for any goods that have been returned, we don't have to receive a payment for them, okay? Basically, they have been returned. So because we went ahead within our debtors account, we had debited this in their account, this sale. In case they are returning, we have to go and credit their account to take into consideration the goods that have been returned, the goods which they will not have to pay for, basically to net off their balance, okay? The same thing with checks received from the debtors. Every time a debtor pays us, definitely it means that they're actually reducing on the balance, okay? They are basically reducing on the balance. And this check could be either be paying our balance brought forward, maybe from the previous period, like the debtor's balance from previous period. It could also be relating to credit sales, whatever we've sold within the period. So any cash or check that is received from the debtor actually reduces your debtor's balance, okay? It actually reduces your debtor's balance. The same thing happens with the discounts allowed. Now, every time we give a discount to our debtors, okay? Every time we allow discounts, I think you now separate the two. We have the discounts allowed and the discounts received. The discounts allowed are to our customers. Now, every time we allow discounts to our customers, let's say 10% of what they are supposed to pay, it means that the amount of money that they would have paid actually goes on to reduce, okay? And that is why we credit it, because it is reducing our amount that we are supposed to receive from these specific debtors, okay? So that is why that one is credited. The same thing similar to that is the bad debts written off. Now, if you remember when we had this class of bad debts written off, we say that businesses work in environments that have cases where some people don't pay when they are supposed to pay, okay? And some people may either run bankrupt. A case in point, if you were, let's say, a supplier to AfriCell, and AfriCell is closing, and maybe you had an outstanding balance with them, and maybe they are declared bankrupt. Maybe they have applied for bankruptcy, okay? And then it means that you're not going to receive any amount of them from them going forward. It means that you have now to write off that debtor balance, okay? Now, writing off the debtor balance also reduces your debtors, okay? Because that given data that you're writing off is the data who will not pay you in the future. You're basically writing them off. So you're basically adjusting them also on your debtors. And that is why this is also credited. So With this, you must now understand why this account looks like this, why each of this item looks like this. And this should also give you an insight on when you find any transaction, okay? When you find any transaction or any item, in determining whether it should be on the debit or credit side, that should be able to guide you. Either it increases the debtors or reduces on the debtors. If anything increases the debtors, include it here. If anything reduces the debtors, include it on your credit side, okay? So that is what basically happens with the sales ledger control account, okay? So this is just trying to explain what I've just done. So we have something very similar when it comes to the creditors control account, okay? We have a very similar process when it comes to the accounts payable. So we also have items that, of course, that are included within our accounts payable ledger account, okay? Just like the way we have cash refunds to customers, here we have cash refunds from suppliers, okay? So we have such cases. So we, let me just right away take you to this account, okay? Just forgive me, this one tried to get distorted, but just imagine this line is supposed to be right here, okay? This line is supposed to be right here. So whatever is on this side is the debit side, and whatever is on this side is the credit side. So what I just want to explain something small here, that the purchases ledger, okay, by the way, the accounts receivable, this that we have just looked at up here, it can be called the debtors control account. It can also be called the accounts receivable control account, but it can also be called the sales ledger control account. The reason why we are bringing sales and debtors is here because the debtors only arise after we've made the sales, okay? So that is a very similar thing when it comes to our accounts payable. So our accounts payable control account can also be called the purchases ledger control account, okay? So that is very important for you to know. So once we have our purchases ledger control account, it means that items, now you know very well that creditors have a normal credit balance. You'll agree with me. Creditors have a normal credit balance, and that is why you're seeing your balance brought forward is right on the credit side, okay? Your balance brought forward is actually on the credit side, and the balance carried forward is on the debit side or carried down, okay? Now, the reason why, of course, like similar to the other, the reason why this one is on the debit side, yet debtors have a normal credit balance, is because as it is a balance carried forward here or carried down right here in this period, in the next period, it will actually be a balance brought forward on the credit side, okay? So that is the principle, basically. So in the same way, whatever appears, if since our balance is on the credit side, whatever appears on the credit side of your creditors control account means that it increases your creditors, okay? It increases your creditors, like just like the way we are seeing here. The credit purchases increase our creditors. Every time we purchase on credit means that it increases the amount of money that we have to pay to our creditors. And that is why it is being included right here. In the same way, checks written to creditors that are dishonored. Now, I think we saw when it comes to the accounts receivable control account, where we say that if a check had been received from a debtor and it had been dishonored, then we should increase our debtors by debiting. Now, in this case, it is us that have given this check to who? To our suppliers. If suppliers go ahead to submit these checks into let's say to the bank and the checks are dishonored, then we should actually come and add it back to our creditors, because whatever value of the check that we had issued and written off these debtors as these creditors as if we had paid them, we have to reinstate them again, okay? And this is where now this is what we now do. We come and credit them once again, and that's why this whole thing is right here. The other is refunds from creditors for overpayment. Similar in the sales ledger control account, we had refunds to back to the debtors for overpayment. And in that case, we say that in that case, if there's an overpayment, then we have to basically come and do what and debit, okay, our debtors account, because when we are paying, we actually credited. Now, when it comes to creditors, you know, every time you pay your creditors, you debit your account, okay? You debit your creditors account because it is when you pay them, it means it's reducing how much you should pay them, the next balance. Now, where you have a case of a refund, okay? A refund, for example, you paid more to your suppliers than what you would have paid them. Any amount that is refunded is actually credited, okay? It is credited because the reason why we're crediting it here, at the point in time when we are paying, we actually debited the creditor's account, okay? We actually debited the creditor's account. I think you know the principle of debit and credit. So in this case, we are crediting it because in this case, it's a reverse of that, okay? So that is what we are doing on the credit side. All those items that are there are items that re-increase the creditors. Now we have a case here, okay? We have a case here which says the return outwards, okay? Now return out, everything that is on this side reduces your creditors. Return outwards. When you send back the goods that you've bought from your suppliers, maybe because of they don't conform to your specifications, or they actually delivered more than they should have delivered, then that alone should be debited, okay? So that's why we debit. We debit it because it should reduce how much we should actually pay for our suppliers, because those are the return outwards up, the value of those goods, we should not pay for them because we have returned them outwards, okay? So that is what happens. When you also pay your creditors, you also debit your creditors control account in the same way. Reason why? Because it is reducing your outstanding creditors balance. And like we've said, anything that reduces our creditors should be debited, both in the normal ledger account, but also in the control account. Same principle, okay? The same thing also happens with the discount received. Now, with the discount received, of course, in this case, it is us that are receiving discounts from our suppliers, okay? It is us that are receiving discounts from our suppliers. Now, every time we receive a discount from our suppliers means that our balance to that supplier is also actually reducing, okay? It means that the balance you should actually pay to that supplier is actually also reducing. And that is why we debit it, because it reduces what we should basically pay. So that is basically what happens. And then we just balance it off as our control account right there, okay? Now, also, basically, of course, we just want to understand, we're saying in the examination purposes, for examination purposes, basically, or what you may find in examination question, the balance of the control account may not agree with the total of the ledger accounts, okay? Yes, for example, you'll be able to see your debtors account not agree with the debtors control account. So what we are saying that in such instances, the cause of difference must be identified and adjustments made where necessary, okay? And such differences may be caused by, one, errors in the accounts receivable or accounts payable control account. It could be errors in the accounts receivable or accounts payable ledger. Like we've said, these two accounts should match, okay? These two accounts should match. The same thing with when it comes to when it comes to the respective ledger accounts. So we should make sure that we are reconciling to make sure that we are dealing away with any kind of errors, okay? So before we look at the advantages, I just want us to look at this question, okay? To see how a control account set. I know you must be asking yourself, how are these control accounts actually set, okay? So how control accounts are set. For example, we have a case here. This is illustration 1. They're telling us that the following details were extracted from the books of a company ended 31st December 2003. So we have debtors balance, this value. We have creditors balance, this value. We have cash paid to suppliers, that value. We have cash received from debtors, that value. We have credit purchases, we have discounts received, we have bad debts written off, we have sales returns, we have purchase returns, we have debtors, check dishonored, we have discount allowed, and then credit sales. And then they're asking us, draw up the debtors and creditors control account, okay? And basically the principle here is very simple. Basically, all that you're going to do is to input this information as it is given, okay? So what I'll just basically do, I just find out what is this company. Okay, this is books of a company. So you just talked of a company. This is an illustration. So I'll just pick, so I want to draw up a debtors control account, okay? I want to draw up a debtors control account. So I'll just come to my Excel and demonstrate this for you. Control accounts are one of those really very simple things to basically do, okay? Once you understand the concept, okay? So let's start with the debtors control account. Debtors control account. And this is okay, since we don't have a name here, let me just try to draw my T account right there. Then I'll just draw my account right there. Like I said, in case you have any question, please use the chat box. I know sometimes I really run, and I run because that is how accounting is. We should be able to do things very fast, but also to mind time, okay? Accounting is not only knowledge, but is also being able to manage time as well. So that is very important, okay? So right here, since I've been given this information, all I need to know when I'm trying to do this question, all I need to know is basically these formats, the way they are. This format and then the other format, okay? So what I'll do to manage time, by the way, if I'm given those two questions, what I'll just do, I'll just copy this and do the other account also. Let me do it even nearer here so we can be able to get. So I'm also doing the creditors control account. Like I said, the creditors control account can also be called the purchases ledger control account, okay? The same thing with the debtors. This can also be called a sales. So when they say sales ledger control account, it shouldn't really confuse you, okay? Yeah. So as you saw, our sales ledger starts with a balance brought forward, basically balance brought forward, as you can see, and then you start inputting the information, okay? You start inputting the information. So what I'm going to basically do, similar to that, I'm just going to come here to my question. Sorry, right here. So this is my debtors balance. This is my balance brought down, the 1.6. 1.6 is my balance brought down. Sorry, I think it's freezing a little somehow. Okay, so I'm here. So since they told me that the balance should be on the debit side, I'll come and record it here. Balance brought forward or brought down, okay? And I'll record the figure is 1.6. Like that. I think it's freezing. Okay, sorry. So, and then they have also given me the creditors control account. So I also pick this and record it immediately. Remember, I'm trying to manage time, so I don't want to first do one thing and then do the other. I'm doing it concurrently. And it's the same advice that I would really give you if you're trying to do these questions. Now, the creditors control account, for it, its balance brought down or brought forward should actually be recorded on the credit side, okay? Which is 2.3. So that is what basically I'm trying to do, okay? And then they are telling us that the cash that was paid to suppliers was 7 million. Cash paid to suppliers is supposed to be recorded under the creditors control account, okay? And we say that anything that reduces your creditors, the payment to supplier reduces your creditors, would actually be recorded on the debit side, okay? So this is 70 million. It's 70 million or 7 million? Okay, this is 7 million. So this is payment suppliers. Is recorded right there. As simple as that. Debit, credit. Okay. Now, in this, of course, these are control accounts. I'm just inputting. I'm not doing a debit credit. I don't have to. I don't need the other account. Of course, if I'm trying to do debit credit, the other alternative account would be the bank that they have paid to. So the next thing is cash received from debtors. Now, cash received from debtors should actually be recorded under our debtors control account. Cash received from debtors should be recorded under our debtors control account. Every time we receive money from our debtors, it means our debtors are reducing. So cash from debtors should actually be credited, okay? Should actually be credited. So that is why I'm going to get my 15 million right here and credit it in this account, okay? Like that. So that's what I'm trying to do. The cash received from debtors, it reduces my debtors. I'll move on. On my credit purchases, the credit purchases. Credit purchases should go to my creditors control account. And what should I do with them? I should credit them. Why should I credit them? Is because they increase my creditors, okay? They increase my creditors, basically, as simple as that. They increase my creditors, okay? Then I'll come to my discount received. Okay, discount received relates to creditors as well, because it is us that are receiving the discount, okay? Discounts received reduce our debtors, okay? Discount received reduce our debtors, and anything that reduces our debtors is debited in the debtors control account, okay? So I'll record the 670 right there, like that. I'll move. The bad debts written off. Bad debts written off relates to sales or debtors, okay? And bad debts written off also reduce our debtors. Every time you write off a debtor, maybe because they have run bankrupt or died, you should reduce your debtors. So anything that reduces debtors is actually credited. So I'll come and credit my value right there, okay? So you're seeing how I'm going systematically, okay? By the time I'm done with the question, I'm done with the two accounts. Then I'll come to sales returns, okay? I'll come to sales returns. Now, sales returns, as you can see, relates to debtors, okay? The debtors control account. Now, sales returns means that we sold to customers, okay? We sold to customers and customers have returned. Sales returns are like return inwards. Now, return inwards reduce our debtors. They reduce our debtors balance. Basically, we're not going to receive money from things that they have returned, okay? So those should actually be credited in this account, the sales returns. Okay, and then we have the purchase returns, the purchases returns. Now, the purchases returns, of course, these in itself affects our creditors control account. Now, purchases returns, this is now in case, this is where we are returning goods to suppliers. Now, in this case, if we are returning goods to suppliers, means that we should reduce on what we should actually pay the supplier since we are returning these goods. So anything that reduces your creditors is definitely supposed to be debited. That's why I'll come and put my purchase returns on this side, okay? Like that. Then I'll move to debtors check dishonored. Debtors check dishonored, okay? Debtors check dishonored. Now, debtors check dishonored is relating to the sales ledger control account or the debtors control account. And this case, it is the check that we receive from our customers that is void, okay, null and void. So we should basically reinstate. We should basically reinstate the debtors by value. Basically, our debtors are re-increasing. Reason why they are re-increasing is because we had written off these debtors, but now they are now coming back to our books because they have actually not paid us, okay? They have actually not paid us. So what I'll basically do, I'll come to here and come and debit my debtors control value. So this is 4,450,000, okay? So go back. They're telling me discounts allowed. Now, discounts allowed also relate to debtors. Now, in this case, it is us that have given discounts to our customers. Once we give discounts to our customers, means that the amount they should actually pay us is actually reducing, okay? So discounts allowed to customers should actually reduce our debtors. They should reduce how much we should expect from debtors. And that is why it should be credited, okay? It should be credited. So just come here. And then the last one is the credit sales. Credit sales increase our debtors, okay? Credit sales increase our debtors. So I'll just pick this credit sales and include it within my debtors account on what? On the debit side, okay? Like that. So I hope that was the last item, and I hope we've been able to record everything, okay? I hope we've been able to record everything as it is. 10 and 12, okay? So if we've recorded everything, then we can be able to get our balance carried forward, okay? Now, in some cases, they will actually give you those balances, but in this case, they need to give us the balance. So we should basically be able to get them, okay? So what I'll just do, I'll just look for a side that is higher. And since I know these are debtors, I know that they have a normal debit balance. So I know that this side will be higher than the other. So I'll just get summation of this. This is about 28 million. So this side would also be the same thing, 28 million, but for it to be 28 million, I should have a balance carried forward, okay? A balance carried forward, and this balance carried forward will be basically, I'll first get the summation of these things and then subtract it from this to be 28 minus this, which gives me 12,270, okay? 12,270 is my balance carried forward there, okay? Let me just try to make sure that I copy and paste values to be able to read this, not confuse you. So I'll come right here Since I know that these are basically creditors, so this side is always higher. So I'll just get the summation of this side. It's 14.3. That's the same balance that should actually appear here. So since it's the same balance, what I'll just do, I'll have my balance carried down, okay, which is the difference between, just try to get the summation of what is already existing. This is about 8.26. So the difference between this and this is about 6,640,000. Okay. Okay. So that is what I basically do have in my accounts. Isn't that simple? Isn't that simple? Are we following? Can I get a response in the chat box? How do you find with chat with contra accounts? Are they simple or hard? Can I get some comments in the chat box? Are these things hard or simple? Or if you have any question, you could also post there. I just want to know from each of you, from your perspective, what we are studying, is it hard or simple? Okay, I see not hard, not hard. So far still simple. Janet is a bit reserved on saying it is simple. So far not hard, as Bet indicates. Yeah, of course, we have to leave that degree because you never know how the question might really appear. We shall see how different questions interplay. Okay, that's why if you're attending this, make sure that you also always attend the revision class as well. Okay, the revision class is not optional. It's basically mandatory to anyone who is part of my class, because I don't usually have a lot of time to try out different examples, and that is why I do what I utilize the revision class to be able to give us that picture. Okay. Yeah. So we have another example here. This is the example that helps us to make sure that we make an agreement of the control account balances with the sum of balances on the underlying accounts. So we are going to see an example here. We have an example here which says that the following example illustrates the types of problem likely to arise in such a system. Okay. Of course, full explanations of the amendments are given. Such explanations would normally be necessary in the examination question. Okay. This illustration and the entries to correct errors are based on the accounts payable ledger control account being in the double entry system. So we have a question here which says that Kagutema's accounts payable control account is an integral part of the double entry system. Individual ledger balances are listed and totaled on a monthly basis and reconciled to the control account balance. Information for the month of March is as follows. So we have the individual ledger balances, individual account balances. We have our total debtors is 102,000, and then the total creditors balance is 2778. So they are telling us that the accounts payable ledger control account as at 31st March is at 21,832 net. As you can see, this is what we have in the control account, and this is what we have in as our total creditors. So ideally, there is actually there's already a difference between the two things. And so they are telling us that on future examination, the following errors were discovered. They're telling us the total of discounts received for the month amounting to 1715 had not yet been entered in the control account. So that is one first thing. And then they are also telling us that on listing out, an individual credit balance of 205 had been incorrectly treated as a debit. An individual credit balance of 205 had been incorrectly treated as a debit, okay? And then they're telling us that a petty cash payment to a supplier amounting to 63 had been correctly treated in the control account, but no entry had actually been made in the supplier's individual ledger account, okay? Basically, they're like errors, okay? And then they are telling us that the purchases journal total for March has been undercast or understated by how much? By 200,000. And then they are also telling us that contras, we have contras, which are also set off between the accounts receivable, with the accounts receivable ledger. Usually this is a case where you have maybe a customer who is at the same time a supplier, okay? I usually give an example of MTN. MTN can either be your supplier as well as your customer. For example, in case you're supplying, let's say, maybe you offer catering services to MTN. You were a customer to, okay, you were basically a supplier to MTN. But then MTN is also supplying with you data, okay? So we have cases where we have contra entries where there's a payment from a same supplier, and then that there's a customer also, and then you have to do, let's say, a set off or a net off, okay? So we have such cases. So with that in mind, they're also telling us that contrast with the accounts receivable ledger amounting in total to 2 deals that had been correctly treated in the individual ledger accounts, but no entry had been made in the control account, okay? So then they're asking us required, prepare part of the payable ledger account reflecting the above information. And then they want us to prepare a statement reconciling the original total of the individual balances with the corrected balance of the control account. Prepare a statement reconciling the original total of individual balances with the corrected balance of the control account. So let's first do the first one. They want us to draw up the accounts payable ledger control account. And this is for Kagutema, okay? So what we shall do, this is Kagutema. Okay, this is Kagutema's account control account. So I'll basically draw my lines there. Okay. So that is what I basically have. So they're telling me I should basically adjust my control account, okay? And as you saw in the question, they gave us different values, okay? They gave us different values that we have, and then also what is the other side, okay? Now, before we actually look at how to attempt this, I want to give you certain steps that you should take. We can try to go through them together here, okay? So the way to approach this question is to consider each of the 5 points in turn and ask to what extent they affect the account payable ledger account, and then B, listing the accounts payable ledger balances. Okay, so we have step one. We have step one. So the total of the discount received in the cash book is dealt with by debiting the ledger control account and then crediting the discount receive account. Thus, if the posting had not been entered in the double entry, then it should be able to clear. Now, this is what they are talking about right here. So they are telling us that the total discount received, we are trying to correct errors, by the way. We're saying the total discount received for the month amounted to how much? To 1715. And they're telling us that this had not been entered in the control account. From the just example we've just done, what happens with the discounts received? Okay, just from right here, discounts received are supposed to be credited. Okay, discounts received is supposed to be debited, sorry, because it reduces on what we should actually pay to the other person. So basically what we are basically going to do within our respective account, even before we do that, what I'll just basically do is we shall first get our balance. Let's first get our balance, what we have. Let's first record this balance. This is what we have before we correct any errors, okay? And we shall put it on the credit side. So we shall come here within the respective account. Remember, this is a payables ledger account, so the balance is on the credit side. So balance brought down, okay? It is that. Just to make it a figure. So this is what we basically do have right there. So our first error has a discount in it. They are telling us that the total discount received for the month amounting to towards this had not been entered in the control account. So ours is actually to enter it there. Okay, ours is to enter it there. And what we are saying that when it comes to this discount, discounts are supposed to be debited. Okay, because they reduce on what we should pay to our suppliers. So I'll come here and write discount received and write the amount right there. Okay, just remove these commas so that is the amount that I do have. So that is one first error. Our first step. Let's see on our second step. They're saying on listing out, an individual credit balance 205 had been incorrectly treated as what? As a debit. An individual credit balance of 205 had been incorrectly. So let's just see what our next step shows here. Okay. The individual credit balance. Okay, just a moment. Say the individual credit balance are extracted from the accounts payable ledger. Like though we said, we said the control account is basically summary account. Okay. So if they are telling us that there is an individual credit balance, so we are saying this is extracted from the accounts payable ledger. So this does not affect our what? Does not affect our either our debit. Okay. Of course, just for you to know that this affects the normal ledger account, but that it doesn't affect our control account. Okay. So that is why in this we shall not affect it within our control account. So just for your understanding, remember what we define when we defined our control accounts, what we said about our control accounts from the start. Remember. Okay. They said it is a summary account appearing in the general ledger for purposes of controlling the detailed entries in the ledger. Okay, so that was the case. And even they gave us an example here where the ledger accounts include Peter and Joy, and the control account would have the 500,000. So that would not affect our control account. Okay, so that is the other transaction. So we shall try to now move to the next one. Okay, this one. So the next one, they are saying a petty cash. They're saying a petty cash payment to a supplier amounting to 63,000. A petty cash to a supplier amounting to 63 had been correctly treated in the control account. Okay, but no entry had been made in the supplier individual account. So as you can see there, ours is to see, are we adjusting the control account? Okay, are we adjusting the control account? Now, as I think you saw, the control account, the error is not in the control account. The error is actually in the individual ledger account, as they are trying to tell us there. Okay, the error is in the individual ledger account. So given that, that would also actually be, of course, also we'll basically also leave it out. Okay, would also not have any adjustment. Then if we don't have any adjustment in this, would also now move to the next one, which says that the purchases journal total for the month had been undercast by what? The purchases journal total had been undercast by 2 million. The purchases journal total for March that had been undercast or understated by 2 million. So ours is to ask ourselves, what do we exactly do with this? Okay, what do we do with this? Now, the purchases, of course, just also understand that the purchases journal definitely, of course, being understated will definitely have an effect to us. Okay, to let's say your accounts payable control journal. Okay, it will definitely have an effect. And how it would have an effect is because you know, a purchases journal records purchases on credit. Okay, it records purchases on credit. Now, if at all they were understated, it means that even in our control account, the value that we have there on the credit side is understated by what? By 2 million. Okay, so we shall basically pick this 2 million. Shall pick this 2 million and come and record it on the credit side. Okay, we shall come and record it on the credit side here as what? As our credit purchases. It's basically increasing our credit purchases. Okay, because we had understated them. So there is a 2 million that needs to be updated right there. So that is how we would tackle that error. Okay, and then they are also telling us down here, they're telling us of a contrast. A contra, which is a set off with the accounts receivable ledger amounting to 2004, which had been correctly entered in the individual ledger, but no entry had been made in the control account. Definitely. Now, what happens with an offset? What happens with an offset is that it reduces on our both accounts receivable, but also the accounts payable. it reduces both our accounts receivable and our accounts payable. So what I mean right here is that this value should, since they had also not made any entry in the control account, this value should actually be entered in our control account. And the side that it should be entered on the control account is a side in which it reduces our creditors balance, which is this side, okay? So the offset should actually be here. This is the accounts receivable offset. The accounts receivable offset like that. So that is what we will basically do with that value, okay? So once we have done that, once we have actually done that, ours is now to basically go ahead to do what? To look at definitely, of course, the two sides. We'll definitely look at the two sides because we've already done the adjustments. So we shall try to get the summation of the two sides. Definitely, this is it's a payable ledger control account, so it has a normal credit balance. So this side is higher than this side. So we have a balance carried down or carried forward. So I'll just get the difference here. This is 3.719. So this will be that minus that. So this is a balance carried down, okay? And once we have a balance down, this total should also be the same thing. Basically, that is what I wanted to effect, okay? This is what I wanted basically to take into consideration. So that is what we basically do have. So this is how your control account will be. So to attempt this, you just needed to understand the dynamics of the accounts payable control account, okay? So that is very, very important for you, okay? So we can just try to finish the question and then we call it a day. So the other question was asking us to prepare a statement that reconciles the total of the individual balances, which is the ledger account. Basically, they want a statement that reconciles this total. Okay, this is debtors balance, but then we also have a creditors balance. So they want us to reconcile this value, since they have given us details around the credit balances, this value with actually our new value, our new balance, the one we've just gotten. Okay, so that is what the reconciling item wants us to basically look at. So we are going to do the reconciliation just here. So right here, we can call it reconciliation. Just pick the narration here. Just trying to pick a heading. So this is reconciling. So I call this a reconciliation. Reconciliation of the original total individual balances with the corrected. So that is just my total, okay? So what I'll just do is balances extracted, okay? So what I'll just do, since I have debit and credit, so I'll have my debit here, and then I'll have my credit, okay? So what I'll do, I have balances as per extract, okay? Now you remember what they gave us? They're saying the individual ledger, the total debits was 101,102. So I'll just try to include that there. I'll include that there. Okay. And then we'll have this. We have that. So that is what we basically do have, okay? So then the other that we should now also take into consideration now, we are going to look at the errors that affected what? Remember, there was something here. Okay, this we accounted for it in the corrected control account. But then we have something here where they say that on listing, an individual credit balance 205 had been incorrectly treated as a debit. Okay, so we have on listing, an individual credit balance had been incorrectly treated as a debit. So basically, the way we are going to correct this, we are going to correct it, of course, within this statement that we are just drawing, the reconciliation. But since they are saying that it was supposed to be a credit, but then it was debited, what we should basically do is first remove it from the debit side. Okay, we should remove it from the debit side by doing what? By crediting. Okay, by crediting with 205. But in the same way, we should also make sure that we actually credit it because it was credited. Okay, so the first 205 is supposed to be credited. Okay, we should credit the first 205 that is actually balanced, is actually reversing out. I can actually even do it here. Reversal of error. So the first 205 should actually be recorded right there. Okay, and then we should now list the balance. Okay, list the balance, which is the 205, which should be credited. I hope you get the principle. This 205 is reverse out what they had put on the debit. Like they have indicated it right here, that the 205 had been incorrectly treated as a debit. So the first 205 that is credited is to reverse out the 205, just like the way we do with ledger accounts. And then the other debit, the other credit is to now include it within the credit side, okay? Or listing it. So that is what we basically do have there, okay? Just include the word credit, list credit balance. So that is how we are correcting that error. And that error, we didn't correct it in the control account because it didn't relate to the control account. But we should basically be able to correct it here. So in the same way, we also had a similar case here where they say that a petty cash payment to a supplier amounting to 63,000 had been correctly treated in the control account. So this we also didn't tackle it because it was already treated right in the control account. But then they are telling us that no entry had been entered in the supplier's individual ledger accounts. So we should basically make this entry within our supplier ledger account. And how do we enter this into our supplier ledger account? Remember, this is 63,000 that is being paid to a supplier. A payment to a supplier in our individual supplier ledger account should actually be what? Should be debited because we are paying the supplier. It means it's reducing the balance. It is reducing the amount of money that we should pay to the supplier, okay? So 63,000, which is a petty cash payment, should be debited. So I'll have a petty cash payment. Okay, which I'm going to debit right here. Like that, okay? That is what I'm going to have. So with that, I'm going to get the totals here. Sorry, this is some. So I'll get that total. I'll also get the total here, okay, which is 21, that, okay. So remember what we have with our what? Our balance is, the balance carried down is basically a debit. Okay, this is a credit balance. Okay, this is a credit balance because as we have it as a balance carried down there, it's actually a balance brought down on this other side. It is a balance brought down on this side. So what we are basically saying is, okay, remember this is a debit and a credit. Now, if we have a debit balance and then a credit balance, and we are balancing off, okay, it is basically, we can say corrected balance. If we want to get the net balance, basically what we are going to do is we are going to get this, okay, we are going to get that, and then less the debit balance, okay. We basically get the credit side and less the debit balance. So as you can see, this 20,113 is now reconciling with what we got as our balance here, okay, on the credit side. And that is why you see, as it is, like I said, as it is a balance carried down here, it's a balance brought down on this side, if you know how to balance off. So in the same way here, when you get the two differences between this, the credit side and the debit side, should be able to come to this. So this, ideally, your control account, your accounts payable ledger control account has been balanced with the normal ledger account to come to 20,113, okay? So that is the principle that we wanted to derive to when it comes to reconciliation. So these are the errors that you could have. If you know very well how to attempt errors in suspense accounts, then this should be very easy for you. And guys, most of these things, by the way, about practice, okay? About practice. Now that we've done this question, I believe there's even an exercise here. There should be an exercise right here. Okay, there's no exercise in this, but you should be able to find different questions that you can actually find in different places. Now, I left out this. This is usually asked, by the way, most times when the examiner sets control accounts. One of the other questions they will ask you are advantages of control accounts, okay? Now that we've just done two numbers that describe what control accounts are, you should be able to understand the advantages, okay? And one of the first advantages that we should understand is control accounts help us to detect fraud, okay? Because you remember, it's like an independent account from your accounts payable ledger or accounts maybe receivable ledger. So in case there are cases where maybe part of your staff committed some fraud, maybe they received money through their individual accounts, then the control accounts are able to help you find out that. Control accounts also help us in checking errors. Like you've seen, we've been able to reconcile between our control account and individual ledger balance by being able to correct the errors that had been made, okay? So that is the other advantage. The other is, of course, to improve management efficiency. It's basically we are able to monitor our creditors and debtors balances in a much better way, okay? And it also saves a lot of time. Rather than us doing a lot of balancing often of, let's say, of our individual ledgers, we already have some balances. We already have where we can easily get our balances directly from, okay? Because they are our control accounts. And then the other one, of course, it enhances your decision making in the same way, of course, your control account can give you guidance of how much money is caught up in credit to customers, and then also help you to things like maybe making provisions for some of the money for cases where some customers are not going to pay you, but also look at the element of payments, knowing how much you should pay to your creditors, and definitely also being able to negotiate for things like discounts and so on, okay? And then lastly, they can also help us to determine the credit sales and credit purchases when it comes to single entry and incomplete records, okay? In the next class, we are going to study about single entry and complete records to help you understand how do we apply this within those respective cases, okay? So be prepared for that. But otherwise, nice having you for this class. For my friends that joined this for the very first time, maybe you've not been part of this, like I think Samuel, I think maybe also other people, I cannot easily tell mostly, but I think Sarah is also not been with us. I think this is your either third class to say, and any other person that got this link for the very first time. We usually have this class every Sunday, okay, at same time, and then we have a class on Tuesday for revision, okay? For those that are preparing for, that just joined us to prepare for the December exam, okay? We want to do catch-up classes to help you get along, to make sure that you get the first classes, okay? We also have recorded videos for the first classes, so we can be able to share alternatively this with you, so you're able to follow through when you join us, okay? So, but I believe that you can easily follow through. I know some of you already have some accounting background, so when you get down, you're able to relate the information and able to remember some of the things you studied either at your degree level, and be able to relate it to now CPA, okay? So pretty very important. So I want to say thank you so much, and I wish you a good night. Make sure that you try out this question, this exercise on manufacturing accounts, okay? This question, and share your solution on the WhatsApp group, okay? Let's see how we can read together on the WhatsApp group. Make sure in case you come across a question, share it on the WhatsApp group and let other people know that maybe help you with the question, okay? And I hope this time you're reading, either you're preparing for which exam, make sure that you're reading every time. Because anytime you take between the time we've started this thing and the time, for example, if you take, for example, 2 weeks or 3 weeks without looking at manufacturing accounts and control accounts, I want to tell you that you're going to get there and you will just be confused. But if you finish this class and you go ahead to try out at least 2 questions on each of the 2 topics before you rest, I want to tell you that even if you take two more other weeks, you already have grasped the concepts. Any question you come across, you can easily. I'll tell you that to teach you some of these things, I don't have to sit down and read them, okay? These are things that have become now a norm for me because I've done them over and over time, okay? So it's the same thing that you should also create within yourself to make sure that these concepts are not concepts you cram. Please don't cram anything. And that's why I want you to understand all these things. And that's why I labor myself to explain why am I debiting and why should discounts received be on the debit side of the creditor's control account. Why should not they be on the credit? Some of you will just say, okay, discounts received are supposed to be on credit or on debit. And at the end of the day, you're going to cram and mess up. I want you to get these concepts from first principles, and I always labor to explain as much as I can. And I also usually give you a ground to ask any questions in the chat box. I actually rarely get questions. So my assumptions is my explanations are a bit elaborate, okay? They're a bit elaborate and they help you to learn as much as you can, okay? Yeah, so thank you so much for keeping here up to this time till we meet again. Today, I really had people join in late. So let's make sure that we join in a little early. I think for up to, I think about 10 minutes, I just had a few people here. Let's make sure we join in early because once I start and you phone me ahead, then you'll be disorganized and it will not be good for you. So make sure that you join in early. Let's utilize the time what we can to make sure that at least every day we are getting down a topic, okay? And then we use the revision classes as well. And then let's see how we can basically run basically through, okay? Yeah, for the topics that we finished, make sure that you are reading them. Make sure that, like I said, for every topic we finished, make sure you at least do 2 numbers minimally, okay? And where you have a challenge, please revert to me. Ask that challenge on the WhatsApp group, and then I'll be able to respond so that other people can also be able to learn from your question, okay? So going forward, especially for my friends that are preparing for the October exam, I should be able to see the WhatsApp group a bit busy with queries and sharing some of your solutions, sharing ideas, okay, and so on. We have to learn together, and we have to learn how to discuss virtually without having to meet. I know some of you have never met, some of you even don't know how I look, but we are learning and we are following through. So why not you be able to discuss? You may not use the WhatsApp group that we are using for classes. You might have friends. You may pick either 2 or 3 friends that you're studying with here, and you can create an individual WhatsApp group where maybe you're able to openly share if you feel the other WhatsApp group is not. But that it shouldn't stop you from using the normal WhatsApp group, because everyone that is on the group is all studying for financial accounting. So feel free to ask any question. Please don't be afraid to ask, because at the end of the day, it is only you who will be in front of that question paper. And that question paper, how you answer it will determine either you're going to pass the paper or you're going to fail it and have to repeat. So utilize all the time that you're outside. And like I said, you actually paid for this training. You not only pay to just come and listen through, but also to understand. So any clarification you need, that should be able to be asked, okay? Yeah, so thanks so much, and wish you well. I hope Michael says thank you for the lecture. You're welcome. I think I should be added to WhatsApp group. Samuel, I'll add you to the WhatsApp group. I think you, the one that paid, only those that have paid that are the ones that are added to the WhatsApp group, just to know. So Samuel, I'll add you to the WhatsApp group, okay? Yeah. So thanks so much, and wish you all the best. I'm going to try to search and see if I can find a number on control accounts from the past papers, but you should also be able to look out for this even before I really share. In case I really delay, make sure you look out for, acquaint yourself, have these papers either on your phone or on your laptop, download it. And you can find this on the iSpower website. Like I said, in case you're not registered and you don't have access, please let me know and I'll get you these papers, okay? Yeah, so thank you so much, and wish you all the best.